Welcome, viewers, to the next in our series of our Fireside Chats with Prentice Wealth Management. My name is Jim Niddle. I'm the president of Ascend Performance, and I'm here with Bill Prentice and Shawn Tesoro, who are going to walk us through a series of topics and discussion items that we think are relevant for you going on in the industry today. I'm fortunate enough to serve as host for today's session and have had the fortunate opportunity to work with Bill, Shawn, and the rest of the PWM team over the course of the past 3 years as it relates to a lot of management, consulting work, a lot of development, and how can we continue to provide exceptional service out to our client base. So again, thank you, everyone. Thank you, Bill. Thank you, Shawn, for the opportunity to be part of the discussion today.
Thanks, Jim, for being a part of it. We appreciate your time and your consideration and caring enough to be here. So we look forward to an interesting discussion. There's a lot going on, and we're going to try to get into as much of it as we can and give some people some useful information.
And you just hit on it. There's a lot going on. So let's jump right in for the sake of our viewers. I know the first half of 2024 was really eventful for financial markets. I'd love to hear your thoughts, and can you walk us through what some of the positives and the negatives that you think we've experienced so far this year?
Sure, I'll start us off, Jim. Economic data was supposed to be a little tepid, and it hasn't been thus far. The economy's held in much better than what's anticipated, and that's been a real positive for markets. It's also kind of kept the Fed at bay a little bit. A lot of folks thought we'd be lowering rates or cutting rates right now, and they're not yet doing that. I think the reason there is that inflation's come in, but the overall economic activity's been better than expected, and markets have rallied on that. Equity markets, at least, have rallied on that.
Yeah, I like that. Bill, would you add anything to that?
Yeah, the fixed income market has been less than what we had hoped for early in the year. Very explainable. Much of the industry was anticipating rate reductions. I think, if you go back and look at our prior commentary, I've always thought the industry was out over their skis in terms of how many they thought would happen this year, and that the Federal Reserve would build a fertile bond market by reducing rates and propping up bond prices, essentially. And our thesis has been for the whole year that we might get one rate cut in the fall. So the bond market hasn't been as buoyant as many have predicted. It is not inconsistent with how we thought it might transpire this year. But there's much to be hopeful for, and we'll get into that a bit later.
Yeah. If we look at some of the conversations that you've been having with clients and just understanding what's been going on across those markets, are there any other key points or takeaways that we should be aware of?
Yeah, I think, Jim, from a client conversation perspective, one of the things we have to manage as advisors and financial planners is keeping expectations in check. When you have a 15% up S&P in the first half, expectations can run a little high. I would argue, I doubt we see the 15% reoccur in the second half of the year. So one of our biggest jobs is to kind of temper expectations. It's been a really good year to date. The goal now is to make sure that we kind of center on temper expectations and get folks to realize that, there's a risk side to everything. We've been rewarded quite significantly thus far this year, and the goal now, I think, would be to maybe bring the risk lens into place here and make sure that we're not out over our skis in terms of risk.
Yeah, I love that comment, Shawn, and I appreciate you bringing that up for myself as a client, as well as, again, our viewers here today, because yes, we need to temper expectations for the second half of the year, which is a really good segue into my next question, which is, as we look to the back half of the year, what stands out in terms of, variables or factors that will impact the markets?
Well, I know Bill probably wants to get into this. I'll kick it off. There's definitely an elephant in the room with the election. The election, we've had a very limited or light volatility year, and I think we're going to see some volatility expand in the second half of the year is my guess. Curveballs left and right during election season. That coupled with the economy, while it's been better, it is slowing. That's good because inflation's coming in, and it may get the Fed to move at some point. But I would say that the election's probably one of the biggest factors that we have to be careful and watch for.
Yeah, and I would assume you're getting a lot of questions today on what are the potential impacts. Is that a fair assumption?
It's probably not as many as you think, very few thus far. But if we just take the last few weeks, right? We've had the former president and Republican candidate an assassination attempt. We've had the incumbent president and presumptive candidate step back and resign his campaign. And so those are unique, not unprecedented necessarily, but unique. And I would say that on balance, given all that's occurred, markets have been extraordinarily resilient. They've demonstrated some real strength here. And I think, that's a testament to the health and well-being of the economy, that it's not getting distracted by some of these events. But I think back to Sean's point on your prior question, we may see a role reversal, right? I mean, the equity markets may have booked the profits they're going to book for the year or close. We've got some data we'll share and some graphics here in a little bit, but markets rarely do 20+%. There's in recorded history, those are unique, and we need to be cautious not to assume that yesterday will continue infinitely into tomorrow and the following. Bond markets as well, they have behaved extraordinarily well very recently, somewhat in anticipation of the Federal Reserve's forward view and that they may reduce rates. Also, though, inflation tends to hurt bonds, especially fixed coupon bonds. So the more inflation moderates, the more beneficial that is for bonds. And then lastly, the final thing I'll add to that is the shape of the yield curve it appears, I can't predict this flawlessly, but it is reshaping right now. That I can say with certainty. And it appears to be moving towards something of a more normalized shape. In other words, lower short rates, higher long rates. In other words, it goes up and to the right in a more logical fashion instead of long rates being lower than short rates. So we'll get into some of that in more detail, but I think there's a lot that is interesting right now. Risk and caution certainly needs to be demonstrated. Discipline, just in general, we talk about that a lot. And not to get overly emotional. Be clear and use your logic to say, is this really going to continue? Do I think we're going to have a 30% year when there have been very few of those in the history of our economy?
Yeah, which is also a good segue to something I'm interested in. How are we positioned from an investment perspective to take advantage of the market opportunities and or protect against some of that downside that you allude to?
Yeah, I'll start on the equity side, Jim. I think the big thing that we need to be cognizant of is valuations. Valuations, while they're not incredibly extended, they are above historical averages, whether it's on a 5-year, a 10-year, a 15-year. So we got to be cognizant about that, number one. One of the things I look for equity is we've had leadership being driven by a smaller number of companies. One of the positives I look for from a market potentially going higher is that broadens out. That can't just be tech, consumer discretionary, and another sector driving it. It needs to be 5, 6, 7 sectors. So that's one of the things we're looking for. We're starting to see that right now. We're also starting to see tougher comparisons for tech companies that have been reporting very good, robust results. But we're starting to see better results from industrial companies, from basic material companies. Usually signs that the economy is holding in there and is performing. So if we can see that broadening continue, I think that's a real positive overall for the market. It may not necessarily mean that the S&P or the Dow Jones goes that much higher, but what it means is that there's less likelihood that we're going to have a fall off. Let's say Microsoft starts to roll over, but you get pickup from, Procter and Gamble, and you get pickup from some of these industrial companies, that you kind of get a leadership rotation that's always positive for the markets. Without that rotation, with tech having these challenging comparisons that they'll be coming up within the next 4 to 6 quarters, it becomes very hard for the market to continue to move higher. We're not saying the market sells off, but if we have a broader set of leaders, it's a lot easier for the market to hold in. Again, I don't think we're going to get another 15% second half. What I don't want to see is a down 15 second half, and I think that can be avoided if we get wider leadership from a rotation into some of the sectors that haven't performed as well.
Yeah, I couldn't agree more. I kind of think of it like a balanced diet, right? If you eat the same thing every day for a month, you will hate it in the end. And this market has been eating tech for a long time. And it makes the market unhealthy. It creates an imbalance biologically to the natural order of markets. There are plenty of great companies out there beyond the scope of NVIDIA and Meta, and which is Facebook, and Microsoft. The market had consolidated to a very large degree, and it's since pulled back a little bit from the tech space, but and we may get into this later, but large cap growth, which is an area in the market where a lot of those companies live and feed, has become an extraordinarily heavy weight inside the S&P 500. From memory, I believe it capped out at around 42%. So of our total, of all of the 9 boxes, large cap growth was 42%, pushing toward half of the total market value. You know, you don't have to be a data nerd to figure out that's extraordinary. So we look at that a lot, and we look at that as, you know, it's great that large cap growth had such legs because it's provided such great returns. It's really the returns we've been fueled on the last, year to 18 months. But it also creates a danger at some point. And we really are quite cognizant of those market anomalies and how they can become dangerous. You know, they can become a bit of a siren song in markets, and they become dangerous.
Yeah. You allude to some of the data that we have that's helping us, make decisions and again explain some of the things that are going on. I know you came prepared with some information that might be helpful for our viewers. Would you mind sharing some of that?
Oh, Jim, you know I would. So what I want to do is I'm going to share this very, very friendly graph. I think it's friendly from our friends at Visual Capitalists. So they make their name in taking data and doing what it sounds like. They visualize it. So this is the S&P 500, and what you see here are years and ranges of returns. So you can see here we've had 1 year, 1931, where markets were down between 40 and 50%. 2008, 1937, 1907 were down between 30 and 40. So we're in a really good year. We don't want to necessarily focus on that. But as Shawn alluded to, we're in the 15% range. But at the market high of the year before the recent pullback, we were pushing toward 20. I believe we were over 18% up at roughly the halfway point for the year. So I started looking at this graph and going back through history to say, what does that look like? And you can see in 2023, we recorded, we logged a year between 20 and 30%. But if you start to think at the halfway point, only 6 months in, we were up around 18%, right? 3% per month. The odds of that continuing diminish significantly. And you can see that it looks like almost a normal distribution. It is not a normal distribution. It is slightly skewed to the positive. In other words, there's more information above the average than below the average. And so, but you also see these extremes are rare, right? Between 40 and 50, and also between 30 and 40. So let's just take where we are now, right? There's a diminishing probability that we're going to continue and record, in my opinion, another 10% or so. We may end up in this category between 20 and 30, but the odds of getting above 30 and certainly above 40 are extraordinarily low. And this data, if you didn't see it, goes way, way back into the 1800s. So this is not, some 20-year analysis or 20-year representation. This is a large data set of behavior over many, many market cycles. And so, Shawn and I had talked about the topic, and I said, what do you think about showing the market histogram? And, it's not often that, we dig this out and we review this, but the market was up so much in such a brief period of time, we thought it would be something useful to share with folks.
It really is. And as I look at that and hear you explain it, one of the things, that resonates is Shawn's earlier comment on, while we've had a very good first half of the year, we do have to be cautious of not assuming those great returns as we look to close out the next 6 months. So, being cautious, and I think the histogram, as you point out, is a good data point to be able to say while we may continue to grow slightly, the odds of significant gains are probably very limited.
All right. So, Sean, Magnificent Seven, you asked for it. There it is.
Well, I think just following up on what Bill just had up there, there's no refuting that the Magnificent Seven or even the 10 stocks, throw in Lilly, throw in United Healthcare, a couple others, have driven a lot of performance in the market. If we look at the top right, the earnings growth year over year column, our year over year chart, you can see, Q1 of 24, 50% growth in earnings by the Mag 7, down 2 by the S&P 500, X the Mag 7. Q2 of 2024 projected, and we're in the middle of Q2 right now, 27. But as we go further out, you'll see the law of comparisons and large numbers start to take shape. The green, the Mag 7, their challenging comparisons are coming, in the quarters ahead. I said the next 4 to 6 quarters. It essentially starts in Q3. As you see, last year we had 30%. Well, last year you had 31% up, and a lot of that was back half driven. The S&P 500, that's the Mag 7. Look at those numbers. Yes, they're 7 and 5 in the next 2 quarters. When we get to Q4, a much easier comparison, and it's allowing that earnings growth to catch up where the Mag 7 is. At that point, if that truly comes to fruition, a lot of people holding Mag 7 stocks, and maybe not all of them, but certain ones of them, or maybe most of them, are going to say, wow, I'm getting similar growth to something that's valued much less than the stock that I'm holding here. Maybe it's time that I step back, take gains in the stock that maybe the challenging comparisons are starting to come to, and go to the stock or the basket of stocks or whatever where the comparisons are much more favorable going forward, and the ability to meet and beat estimates becomes a much more positive driver of the performance of those stocks. So we're not saying the Mag 7 is going to sell off. I'd argue that some of the Mag 7 will continue to do well. They're spending, they're investing a lot, they're doing very well. If you look at forward orders and whatnot from hyperscalers, they're there. They've got positive momentum. But I'd argue some of them, we're starting to see it from Tesla. Their numbers are their numbers are coming down. The comparisons are getting a little more challenging. So we have to start to decipher who is the growth engines moving forward, and then who are the ones that, whether it be challenging comparisons, new entrants into their space where maybe their margins have been higher than what would normally be come to hold. And all of a sudden you start to realize that maybe from a risk perspective, we need to kind of shift our perspective and look to a broadening out market in areas of the market that maybe haven't performed that well, but are putting up earnings growth that is close to as good or better than Mag 7 or some of the other stocks that have done well.
Yep. That makes sense.
Sean, can I ask 2 questions?
Sure.
Can you define Mag 7?
Yeah.
Who are the 7?
So the Mag 7 are essentially Amazon, Meta, Microsoft, Google, Alphabet, which Google's called Alphabet now, Apple, Tesla, and NVIDIA. And NVIDIA joined, at one time it was FANGs, and then it went to Mag 6, and NVIDIA is the most recent to join. And NVIDIA's had a heck of a run here, and they're well ahead of their peers right now. But I'll tell you what, in semiconductors, we always see this. There will always be the first mover advantage, and that does hold until it doesn't. And when it doesn't, and they've got AMD nipping on their heels in terms of being able to impact their margin by offering prices on products at lower numbers, that will be problematic at some point down the road for NVIDIA. Again, I'm not saying I'm negative on NVIDIA here, but that said is their 70% margins will come under attack at some point, and the competitors within their space will narrow the gap on technology with them at some point.
I'm going to kind of skip forward from that because I'd like to talk about this bottom right, because a lot of what we talk about and what we do is manage risk. And so I find this graph to be somewhat compelling because we've been in a hype phase, right? Led largely by numbers like this and numbers like this. And I find it quite compelling just as a back, and we need to keep this in mind. This is the number, as I'm sure you're shocked to see, Sean, that I focus on.
Yep.
Right? That these things aren't perfect, right? That an extraordinary downturn is possible. And probably I'll reflect a little bit on the dot-com era. I do not believe this is the dot-com era 2.0. There's been some press to that effect. However, these companies are betting on the future. And there are some similarities in terms of hype around what the future might look like, which cannot be predicted flawlessly. And again, not saying this is happening, but I use a company like Cisco that is absolutely the dominant, one, two, three best network equipment manufacturer in the world. Very little doubt in that. But they have not made it back to their all-time high stock price in March of 2000. And you can be a great company with good numbers and strong business fundamentals, but your stock can very much disconnect from the reality of the future. In other words, it can be overpriced. But the reason I bring this up is NVIDIA has been on a torrent of a run. It doesn't mean there's no downside to it. NVIDIA is changing our world. They are revolutionary in their product. But there are some, I'm going to turn this back to you, Shawn, but we as wealth managers need to be mindful that a small earnings disappointment, a small miss on sales, revenue, all sorts of things that could happen may be met with a violent retracement in the stock. And that can have real impacts if you're over-concentrated. So, Shawn, I'll give it back to you because I know we've had some calls with some tech analysts about potential for double orders. And then, if you want to, I don't know if you do have this in your agenda, but maybe we could talk a little bit about the second and third derivative plays here and how it's not just about the chips. There's a massive, second, third, fourth, fifth derivative potentially implication downstream for this.
Yeah, I won't belabor everybody with the depth of this, but if AI does play out, AI will have its positives and negatives, pros and cons over the next decade or so. But it's going to be a decade story that plays out here from a thematic perspective. Very similar to what we saw with mobile web, very similar to what we saw with the first iteration of the internet, the .com. The companies are just much savvier now than they were in both of those iterations before. But that said, if you could go back, Bill, or you don't have to go back, but I can point to the best performance, NVIDIA was 239%. When that number gets higher and higher, that's more of a worrisome factor because NVIDIA has to not only comp the performance from an earnings perspective and a revenue perspective, they have to comp the portfolio performance, the price of their stock performance. And that gets very daunting at some point. Doesn't mean that NVIDIA won't be higher in 5 or 10 years from now, but it's not a straight line. It never is. And I think that's something that we need to watch here because I spoke about it. NVIDIA has 70% margins. Those margins don't stay at 70% without your competitors or without others that aren't even in the space saying there's margin opportunity there if we go and grab it and get more competitive with NVIDIA. Easier said than done, but Advanced Micro Devices is not that far behind NVIDIA. They're probably 6 months, maybe 9 months behind. And that might seem like a huge gap right now, but that can narrow pretty quickly. And it'll narrow really quickly when the hyperscalers. So hyperscalers are those Microsoft, IBM, Google, Meta, Amazon, all the big, massive e-commerce, internet, social network players that are investing dramatically in this technology to the tune of $100 billion a year. AMD will go to them, and they're going to them right now, and they're saying, you can't get enough chips from NVIDIA. You can't get enough chips for us. But going forward, we can help you lessen your price when you go to get chips from NVIDIA because we're going to partner with you. We're going to put a fab together. We're going to use our fab presence that's already in place in Taiwan with Taiwan Semiconductor, and we're going to help you design your own chips, and to the point where you're not going to be able to neutralize or take NVIDIA out of the equation, but you're going to have a lot more say about what you're paying for that chip going forward. Some of these NVIDIA chips have gone from 10,000 to 40,000 just year to date. The same chip. It's a powerful chip. It's in demand. Tesla wants to buy them. Amazon wants to buy them. They want to store up with them. They want to kind of grab them all for themselves like the Cookie Monster. I had to make that fun. But that's really what's going on there. But if I'm AMD, if I'm some of the other players in the space, there's a huge opportunity to look at that 70% margin and say, we can get you a chip that's almost as effective or nearly as effective, or it can be your second and third chip at a fourth or a fifth of the price. And that's very eye-opening to the Microsofts of the world because that is their goal. Their goal is to bring their pricing down because they don't want to spend 10, 20 billion a year for the next 10 years. They want to spend the 10, 20 billion up front, and they want it to be 5 to 7 in a couple years, and then 3 to 5 when they've already got their leadership position in the place. So what they will do, like anything consumer electronics, semiconductor related, it comes at a very high price, but eventually that price starts to decline, and it declines pretty rapidly. So that, I think, is what we're going to see. Again, that's no disrespect to NVIDIA. They've had the first mover advantage. They've got technology that's way ahead of everybody else, but the gaps are narrowing, and that is something why we're spending a lot of time doing research on AMD. We're spending a lot of time in the storage space with Micron, with Dell. We're spending a lot of time on cooling because these data centers use a ton of energy, a lot of that air controlled energy that can be done with liquid cooling at much more effective and efficient pricing and whatnot. So there's a lot going on in the space, and that's just the first 1.5 kind of waves. Bill, there's a lot behind that. If we want to have our mobile phones and our laptops be able to use AI more inside your own enterprise instead of going out to the cloud, you need a lot more power in this computer and in this laptop, and that's memory. That's Micron, that's Dell, that's players that they call it on the edge, your edge products like your laptop or your phone, and that's where we're going. But this is going to take some time to get there, and I seriously think this is a decade out, the whole theme to play out. And by the time it plays out, I hate to say it, but the software guys are like the last ones to participate, but they will participate. Microsoft will make a ton of money off of AI. They're already making money. They'll make 10 times what they're making now once the generative AI goes to a different level and it gets inference and things of that nature. So again, I probably went a little too deep, but as you can see, this is a theme that we haven't seen in markets since probably mobile, and maybe you could argue that you've seen it with the GLP-1s, with the weight loss drugs and the diabetes drugs, but you haven't seen it, a theme like this. So everybody is bowled up about it, but not everything goes up and to the right.
Can I just add summary to that real quick? Is from my vantage point, what Shawn said, to decode and wrap that up, is the technology that we're seeing right now on the front end is the tip of the iceberg. This will impact everything down a supply chain extremely low, all the way to the local utility companies. And there is cause, I think, for optimism in this. And I want to be clear in terms of my prior comments. I am not certainly against this tech shift. This is going to be, has the potential to be clear, we don't know what it's going to look like, but has the potential to be absolutely extraordinary. Similar to the dot-com, and you could even go back further and draw analogies to things that were much more fundamental to how we did business. The typewriter and the word processor, you could almost go back that far. This is a powerful, powerful thing. And I'll just share this last thing and then I'll turn it back to you, Jim. I just ordered a new laptop. It has 3 processors, and the specs on it are by far the biggest I've ever had. It has a graphics processor, it has a regular core processor, and it has an artificial intelligence processor in it. And that it's a Microsoft laptop with a Qualcomm chip in it, and the battery life is less than what I could have got had I not had the AI chip. But I also, and this is really where I'm getting to Shawn's point about memory, more memory than I've ever had. My desktop is absolutely adequate and powerful. I have double the memory in this laptop because I know I'm going to need it, and I paid up quite a bit to get that. I have 64 gigabytes of RAM coming in this laptop, and it's going to use every ounce of that if AI really happens.
So thank you for both of you for sharing that. I guess from a summarization perspective, as we contemplate the conversation we've had so far around the first half of the year, what's to be potentially expected on the second half of the year, the influences based on, market as well as governmental changes. How would you leave our listeners with 1 or 2 bullets of things that they should be considering?
So I had to ask Shawn for permission to do this.
He did not.
So louder, more volatile equity markets, more fertile ground for fixed income, and a portfolio balance, in other words, a mix of multi-asset stocks and bonds in the same portfolio, that yin and yang in a very productive way. In other words, the profits that were made in the front half of the year in stocks are able to seed and help grow, if you will, and through rebalancing the fixed income component of a portfolio. And the fixed income portfolio should be resilient and in the best, robust if we do get any rate cuts and inflation continues to moderate. So I know this is kind of odd, but Shawn and I were talking about this the other day. How do you feel about equity markets? And we're both kind of like, eh. And he asked me how I feel about fixed income markets, and I'm like a strong 8. And he goes, "Really? Tell me more." Right? So it was almost like I was talking to you, Jim. So, and I stated my case. He said, "Oh, I could go up a couple of points then." Like that, like I didn't see those layers. And, that I think is where that fabric of Sean and I, working, collaborating, dissenting in a productive way, that's why, right? That's why it works, and why a multi-asset portfolio, not just that, but why there's real benefit at times in having a multi-asset portfolio that has a disciplined approach, a robust investment approach around it.
Absolutely. And thank you for sharing that. So I want to thank both of you for your time today. This was enlightening. I think, again, obviously very timely, given everything going on in the world. Again, thank you for the opportunity to be part of the conversation. I'm interested to see in our next session how some of these thought processes and forecasts to a certain degree start to play out. So again, thanks. I'm looking forward to the next in our series, and just want to enjoy the rest of your day.
Right.
Thanks, Jim.
Same to you, same to our viewers, and thanks everyone for tuning in and spending a few minutes with us. Appreciate it. Appreciate your time. Thanks.